Before the S&P 500 became the go-to barometer, how did anyone make sense of the Wild West? That was the early American market. Our journey starts way back, right? 1806, with the very first attempts at market indexing.
Indeed, yeah. It was Dow Jones who really pioneered the concept, which eventually evolved into what we know as the Dow Jones Industrial Average. Its goal was pretty simple back then. Offer a digestible snapshot of the market by picking leading companies from key economic sectors. Sort of an early compass for investors, but like you said, just the beginning.
Right, so you had Dow Jones creating that first market compass, but the path to the S&P 500 started with two separate, almost unlikely companies. Tell us how those independent threads eventually, intertwined to form the powerhouse we know today.
What's truly fascinating here is the almost parallel evolution. You had Henry Varnum Poor, who started Poor's Publishing way back in 1860. Initially, his focus was just investor guides for the booming railroad industry. Can you imagine?
Worlds away from today.
Totally.
Yeah.
Meanwhile, in 1906, the Standard Statistics Company popped up. By 1923, they developed their first stock market index. It was 233 U.S. companies computed weekly. Then just 3 years later, they expanded that to a 90 stock index computed daily, much faster.
Okay, so these two different entities, one focused on railroads, the other on stats and early indexing. They eventually found each other.
They did, yeah. In 1941, Coors Publishing merged with Standard Statistics Company, forming Standard & Poor's. And that merger really set the stage, creating the unified entity that would, eventually revolutionize how we measure the market.
Okay, so from those early beginnings, we leap forward to the mid-20th century. The market was booming, but it sounds like it desperately needed a more comprehensive measure. What was the exact moment the S&P 500, as we kind of understand it, truly debuted?
Right. The watershed moment arrived on Monday, March 4th, 1957. That's the date. That's when the index was officially expanded to include 500 companies and was rechristened the S&P 500 Stock Composite Index. And literally the very next day, the New York Times ran an article, big announcement, this new Standard & Poor's Corporation Index of 500 common stock issues.
Wow. And that article, I think our sources mentioned, it even described it as a new gauge of the market made possible by the marriage of a stock market ticker with an electronic computer. For 1957, that sounds incredibly visionary, doesn't it? How truly groundbreaking was that combo finance and tech back then?
Oh, it was absolutely revolutionary. I mean, think about it. Marrying real-time data from a stock ticker with the computational power of an electronic computer. That was a massive leap. This new index immediately grabbed attention because it represented more than 90% of the value of the New York Stock Exchange common stock issues held by investors.
90%.
Huge. It was designed from the start to be the definitive proxy for the entire U.S. equity market, a role it pretty much maintains to this day, becoming the most widely quoted American index. It shifted market understanding from, a limited snapshot to a broad, computationally precise reflection.
So we've journeyed through its fascinating history. Let's bring it right up to today. When the news mentions the S&P 500, what exactly are we visualizing beyond just those historical roots? What is it now?
Right. At its core, the S&P 500 isn't just an index. It's really considered the definitive bellwether. It tracks the performance of 500 leading companies listed on U.S. stock exchanges. And it captures roughly 80% of the total market capitalization of U.S. public companies.
80%. Okay.
As of, August 29, 2025, its aggregate market cap was over $57.4 trillion.
Whoa.
It's essentially the pulse of the American corporate giants.
That's a staggering number. And didn't our sources mention it actually has 503 components, not exactly 500? Why the extra 3?
Good catch. That's a great detail that highlights the precision involved. It's because 3 companies within the index have 2 different share classes listed. Now, the key to understanding its movement lies in its free-float capitalization-weighted method.
Free-float cap-weighted. Okay, what does that mean exactly?
It basically means companies with larger market capitalizations, based specifically on their publicly tradable shares, have a significantly greater impact on the index's value.
Okay, so a company's sheer size, its public float size, dictates its influence. What does that look like in practice? Can you give an example?
Sure. To illustrate, think of it this way. A single company like, say, Apple might represent nearly 5% of the entire index.
Hmm.
As of May 27, 2025, Apple's market cap was around $2.99 trillion, giving it about a 4.9% weighting.
Wow, almost 5%.
Exactly. So this means a mere 1% shift in Apple's stock price can move the entire S&P 500 more than a 1% shift in dozens of smaller companies combined. It truly highlights the outsized influence of a few giants at the top. In fact, the 10 largest companies alone account for about 38% of the index's market cap.
38% just from the top 10. That's concentrated. And what about the sectors represented within that massive total? Which parts of the economy are most heavily featured?
Yeah, looking at the breakdown as of September 4, 2025, information technologies dominance at 33.3%. Yeah, it's a huge shift from earlier eras and really reflects the evolving structure of the U.S. economy. Financials follow 13.9%, and then consumer discretionary at 10.6%. And those top 10 largest companies, you know the names: NVIDIA, Microsoft, and of course, Apple.
Right. So we know it tracks these 500 plus leading U.S. companies, but what are the rules for getting into this exclusive club? It can't just be about being big, can it?
That leads us to a really crucial point: how these companies are selected. Unlike some indices that are strictly rule-based, purely quantitative, the components of the S&P 500 are chosen by a committee.
A committee?
Yes, a committee from S&P Dow Jones Indices. This discretionary power, this human element, is a truly unique insight, setting it apart from many other indices.
A committee? That sounds quite powerful, allows for some subjectivity maybe. What are their key criteria beyond just size? Like, could a huge, profitable, but maybe privately held company have any chance, no matter how influential?
You're spot on. It's not just size. And no, private companies are out. The primary criteria include things like market capitalization greater than or equal to, let's say the number, US $22.7 billion as of July 1st, 2025, plus robust market liquidity, a minimum monthly trading volume of 250,000 shares for 6 months straight. And, crucially, the company must be US-based, with its primary listing on a major US exchange like the NYSE, NASDAQ, or SIBO.
Yeah.
Certain things like preferred stock or, ETFs themselves, they're explicitly ineligible.
Okay, makes sense. And once a company is it like tenure? In for good? Or do the committee's decisions mean companies can be added or removed?
Oh, definitely not in for good. The committee regularly rebalances the index. Things change. For example, on April 23, 2025, companies like Coinbase Global and DoorDash joined, while Discover Financial Services and Celanese were removed. So there's turnover. Our sources also mentioned an interesting study, I think it was October 2021, from the National Bureau of Economic Research, which alleged, and I want to stress alleged, that companies' purchases of rating services from S&P Global might appear to improve their chance of entering the S&P 500. It's an intriguing point for critical thinkers, food for thought. But again, we're just conveying the idea from the source, not endorsing it.
Right, noted. Okay, so this index has been around quite a while now. What does its track record look like? How has it performed over the decades? And what does that tell us about the market, long term?
Yeah, if we connect this to the bigger picture of long-term investment, the S&P 500 has a really remarkable history. Since technically its data goes back to 1926 for calculation purposes, the intuitive compound annual growth rate, including dividends, has been approximately 9.8%.
Almost 10% a year, compounded.
Yeah. And even after you account for inflation, that's still around 6% annually, which is pretty solid over nearly a century.
That's impressive. But markets aren't always up, are they? It's definitely not a smooth ride.
Oh, absolutely not. Those 30% drops you mentioned, those are the ones that test an investor's resolve. While it has posted annual increases about 70% of the time, which is good odds, it has also declined by over 30% in several years. Market volatility is very real.
Sure is.
But despite that, it's kind of a testament to its long-term strength that 5% of all trading days have actually resulted in record highs. And speaking of record highs, it just hit one very recently, 6,512.61 on September 9, 2025. That was even after a bit of an intra-year correction earlier in April.
Okay, so definitely a long-term play for many investors, rewarding patience. What are some of the key milestones in its climb? What do those big jumps in points, like hitting 1,000 or 4,000, reflect about the broader economy?
Right, these aren't just arbitrary numbers. They really reflect these seismic shifts in the American and, frankly, the global economy. It took a little over a decade just to close above 100 for the first time. That was June 4, 1968. Post-war growth, maybe. Then it gained momentum. Closing above 1,000 didn't happen until February 1998, right in the dot-com boom. Then over 2,000 in August 2014, past 3,000 in July 2019, and cracking 4,000 by April 2021.
Wow, the pace picked up.
Yeah, the acceleration later leaping from 2000 to 4000 in just 7 years, that tells us a lot about the pace of innovation and capital allocation in today's economy, especially in technology.
That's an incredible track record, really showing the power of long-term investment in this index. But here's the burning question for anyone thinking about these numbers. Can you just buy the S&P 500 like it's a single stock? How do you invest in this?
Yeah, that's a crucial distinction for investors. You cannot invest directly in the S&P 500 because it is an index. It's a hypothetical portfolio, not a tradable asset itself. However, you absolutely can gain exposure. You do that by investing in mutual funds or, more commonly now, exchange-traded funds, ETFs, that track its performance.
Okay, so these funds, these ETFs, are essentially striving for a near-perfect mirror image of the index, holding the same companies in the same proportions.
Exactly. Companies like the Vanguard Group, with its VOO ETF, iShares with IVV, State Street Corporation with SPY or SPLG. They offer popular ETFs. They replicate the index's performance by holding its constituent stocks in the same weighting. So you get that broad market exposure. And for more sophisticated investors, there are even things like futures contracts offered by the Chicago Mercantile Exchange or options trading on the CBOE. In fact, fun fact, the Vanguard Group offered the very first mutual fund to retail investors that tracked the index way back on August 31st, 1976.
Okay, Vanguard. Pioneers there. So the S&P 500 is clearly a big deal, the preferred benchmark for many. But it's not the only index out there, is it? How does it stack up against others we hear about, like its older cousin, the Dow Jones Industrial Average, or the ever-present NASDAQ?
Yeah, that's a crucial comparison, yeah. The Dow Jones Industrial Average, with its, 30 stocks? It's often associated with a quick snapshot, maybe more familiar to retail investors sometimes.
Sure.
The S&P 500, however, with its 500 companies across all sectors, is frequently the preferred index for institutional investors.
Yeah.
Why? Because of its significantly greater depth and breadth, covering that 80% of U.S. market cap.
Right, much broader.
The biggest difference, though, fundamentally, is weighting. We talked about the S&P 500 being market cap weighted. Bigger companies have more sway. The Dow, on the other hand, is price weighted.
Ah, right. Price weighted, not market cap.
Exactly, which means a stock with a, say, $500 share price will impact the Dow index more than a $50 stock, even if the company with the $50 stock is actually much larger overall in market cap. It's a subtle but really crucial distinction.
Okay, that is different. And what about the NASDAQ? We hear that name a lot, often tied to tech stocks. Is it another index or something more?
Yeah, you often hear the NASDAQ, and it can actually refer to two things. First, it's the electronic stock exchange itself, where many big tech companies like Apple and Microsoft list their shares. Second, it's also a family of indices, like the popular NASDAQ 100. That one specifically tracks 100 of the largest, most actively traded common equities on that NASDAQ exchange. So many S&P 500 companies are also listed on NASDAQ, making it a critical exchange, especially for growth companies. The NASDAQ Composite Index, for instance, includes over 2,500 common stocks listed there.
Got it. Exchange and indices. And is the S&P 500 itself part of a larger family of S&P indices?
Yes, it is. Good point. The S&P 500 is sort of the flagship, but it's a key component of the broader S&P Global 1200 family. This family also includes the S&P Mid-Cap 400 for mid-sized companies and the S&P Small-Cap 600 for smaller ones. If you combine those three, the 500, 400, and 600, you get the S&P Composite 1500, and that covers an impressive 90% of all U.S. market capitalization.
90% coverage there.
Yeah. And then you also have the Russell indexes, like the Russell 1000 or 2000. They're similar in using market cap weighting, but they use a more formulaic selection process, less committee discretion, and they can sometimes include the same company in both their value and growth style indexes, which the S&P generally doesn't do.
Okay, interesting distinctions. So, wrapping this up a bit, what does this all mean for us, the listeners? Is the S&P 500 a perfect representation of the market? Or does it have limitations we should maybe be aware of when we hear that number?
That brings us to a really crucial point about how we interpret these powerful indicators. Nothing's perfect, right? Yeah. One of the main limitations of market cap weighted indexes like the S&P 500 is that concentration risk we talked about. If a stock with a really heavy weighting, like one of those top 10, becomes potentially overvalued relative to its actual fundamentals, its sheer size can disproportionately inflate the overall value of the index.
So it's not always a pure reflection of underlying company health across the board. The biggest companies can have an outsized impact, even if their growth isn't entirely justified by operations.
Exactly. A rising market cap simply reflects an increase in a stock's price, its perceived value, not necessarily improved fundamentals like earnings or sales growth across the board. Yeah. And this potential distortion has actually led to the increasing popularity of things like equal-weighted indexes.
Ah, equal-weighted.
Yeah, where each company's stock price movement has an equal impact, regardless of its size. A 1% move in the smallest company matters just as much as a 1% move in Apple. It just encourages critical thinking, What does an index truly represent, and does its weighting method align with what you're trying to measure or understand?
That makes sense. Well, today we took a real deep dive into the S&P 500. We traced its journey from that mid-20th century innovation to its status as the leading barometer of the U.S. stock market and economy. We've explored how Standard & Poor's came to be, the specific criteria a company needs to meet, how it's weighted, and its remarkable, though sometimes volatile, performance over the decades.
It truly is a dynamic measure, isn't it? Constantly evolving with the market. And understanding its history and mechanics like that unique role of the selection committee or the profound impact of market cap weighting, it gives you invaluable insight into the financial world, how fortunes are made and measured. These insights really offer a deeper lens through which to view economic news.
So what stands out to you listening today? The next time you hear the S&P 500 mentioned in the news, maybe consider not just the number, but the incredible tapestry of those 500 leading companies, the complex history of its creation, and the intricate calculations, the weighting behind that single figure.
And perhaps, ask yourself this. As our economy continues its rapid transformation, really dominated by new technologies and global shifts, will the S&P 500's committee-driven selection process remain the ideal way to capture the cutting edge of American industry? Or will new approaches, maybe more rules-based or different weightings, emerge to challenge its long-held dominance?